This is your Wall Street wake-up call. The markets await the Bank of England's August policy meeting, which wraps up on Thursday. With me now is Maximilian Kunkel, a cross-asset strategist at UBS Wealth Management based in Zurich, Switzerland. So Maximilian, it's great to see you. The big question now is, do we get a rate cut at this meeting? This is the central bank's second meeting since that Brexit vote back in June. What do you think?
We think there is going to be a rate cut tomorrow, and also likely some additional stimulus going down the way into the next meeting. So we're expecting 25 basis point cut tomorrow and likely another 25 basis point cut in November.
And don't you think it's still a little bit early to gauge the fallout from Brexit? I mean, of course, as you know, the BOA sort of kept things where they were at their last policy meeting, which was only 3 weeks ago.
No, we think actually, particularly if you're looking at the latest leading indicators, so this week in particular the PMI figures that were extraordinarily beaten down in the UK, it's now time for the Bank of England to act and also specifically also communicate to the market what its further plans are in order to continue to stimulate the economy.
Well, and many question the efficacy of a 25 basis point cut to its benchmark rate. I mean, what will that do?
Likely it's here much more about a signal from the Bank of England that it is willing and able to do further things. And I think it's not just about the 25 basis point cut, because that's pretty much priced into the market at the moment. It's much more about what the Bank of England is indicating it is willing to do, and specifically also what its forecast is going to be, both on the inflation as well as the economic growth side of things.
All right, and then elsewhere, what's your take on the stock market right now? What are you telling clients? We're seeing record highs here in the U.S. and stocks largely higher across the board.
Yeah, so specifically when it comes to the United States, we've been overweight the U.S. equity market for quite some time, and have recently actually increased our overweight to U.S. equities. Specifically, we think that although valuations continue to be relatively elevated, but clearly not excessive, earnings growth should continue to resume during the second half of this year, as both the oil price is starting to stabilize around these levels, and the US dollar is likely going to be more range bound than what we had previously seen. So based on that improvement in earnings, we also think that the US market is likely going to go higher from here.
So you don't think that oil below $40 a barrel, which was what took place earlier this week, is a problem for the stock market?
Short term, yes. And short term also, we think that oil is likely going to continue to be under pressure. We've seen recently record inventories in the United States. We've also seen some of the recently cut down production in areas like Canada coming back to the market. And at the same time also we're seeing a temporary reduction in demand growth out of emerging Asia. But going a little bit longer term, we're continuing to see a contraction in non-OPEC supply for the first time since 2008, and also healthy demand growth. So our view would be that the oil price should start to move higher again after the short-term correction that we're seeing now. And we're forecasting $55 for next year, as the market is likely going to balance in 2017 again.
All right, all issues will be following. Maximilian Kunkel from UBS Wealth Management in Zurich. Thank you so much for joining us.
Thank you.
I'm Scott Gamm, and you're watching The Street.